Today, folks, we just got some of the biggest news I've seen in a very long time coming out of Telus, of all things partnering with NVIDIA. And I want to break down this partnership to build out new kind of cloud data centers, or basically building out the existing ones that they own. And I want to firstly, before we get into that, pose the question of how do you value infrastructure, like telecom infrastructure? Because I've talked about this for a while. These companies are necessities, right? Like they can't go anywhere. They're literal things we are using on the daily basis just as much as our iPhone, specifically in Canada, where they're controlled by these monopolies, right, that are pretty undisruptible thanks to basic, laws that prevent other companies from coming into our country and offering, telecom services. And it's just really unique to be in a circumstance where these stocks have crashed so heavily, through the interest rate cycle, through concerns of competition. We are facing lower population growth on the back of basically, the government just trying to build up the infrastructure that we currently have with housing and everything. But that all has kind of bubbled up to a very bearish sentiment, but what I would consider to be a short-lived bearish sentiment, right? Because eventually the economy is going to get back on track. Eventually they're going to open up immigration because they're only blocking it for a couple of years. Like everything that I'm hearing about seems to be short-term, but still doesn't stop you from canceling your phone plan. Or, I just feel like we're so locked in with these people, regardless of what happens economically, you still need a phone plan, right? Like it's not going to change people's spending habits. And if we just take a look at the statistics here, which I find really interesting, because they're claiming the enterprise value of Telus is about 61 billion. The market cap today sits at around 32, right? We're sitting about 32 billion dollars. The trailing PE, which I do not really trust the price to earnings, because the earnings do not take into consideration the depreciation and amortization. But if you want to talk about price to earnings on infrastructure, it's kind of hard, but still forward PE is sitting around a 20. When I kind of scroll through this, I'm just shocked when you look at the current value metrics, because they actually aren't even that extreme for where the company sits today. And a lot of people tend to point out their profit margins, their return on assets and equity being pretty low, but that's because these companies are right now investing a heavy amount into basically upgrading into fiber. They spend a lot of money upgrading stuff to try and bring us into the new realm of speeds, competition, which has caused some price fluctuations because there's a lot of competition out there right now. Surprisingly, not a huge amount of short interest. I've noticed, about 3%, 4% short interest, which is still higher than I think some companies, but it's not that material, with 56% being held by institutions. You can go through these statistics all you want, but what I really find intriguing is the stability of the revenue, even on the back of whatever happened through 2014 and 2016. I'd be curious to see what the history here was, which caused like a $2 billion revenue bump to the downside. But we've actually seen some very, very stable revenue right now on the back of, again, I don't think we've seen the impacts fully of slower immigration, but if the revenue remains as strong as it's remaining right now, and we continue to see a net income recovery, which is what I've talked about on the back of interest rate cuts, that they should start seeing, a bolstering of all the debt that they have on the balance sheet, right? Because if you take a look, these are companies that are highly debted. I've talked about this before. You take a look at the balance sheet here. We're talking about a company with $41 billion in debt and $58 billion in assets. In fact, they're only trading about $10 billion off their asset to liability. This is a company that is slowly approaching being worth more sold off as parts than it is as a publicly traded company. This is why the confusion comes into play with the real value of these companies are. But we are starting to see that net income recovery, right? And I think this is a trend that's going to continue, because the company went through, restructuring. Like in the midst of the interest rate cycle, they laid off a lot of people. They had to pay out a lot of severance packages. Their debt started to go up pretty dramatically, right, on those payments. But again, all of that now is starting to unwind, and we're going into what I consider to be the light at the end of the tunnel, though there is still a rocky economy we're facing that could hinder some of the recovery. But I'm really suspecting that if we continue to see net income growth, the stock should start to continue to follow that price, and this should be hopefully where we start finding a bottom, which is why I picked up shares. But I'm shocked to see that the stock's going down over the last couple of days on the back of like some absolutely incredible news. And I'm going to read this to you real briefly. Let me zoom in, because Telus launches basically Canada's leading sovereign AI factory powered by NVIDIA to drive the nation's AI future. Essentially, a powerful and super secure facility that will give Canadian businesses and researchers access to cutting-edge technology, helping them develop smarter AI products, streamline operations, and stay competitive in a fast-changing world. It provides the supercomputers and software needed to train AI while keeping data safe within Canadian borders. Telus plans to deploy NVIDIA's latest generation industry-leading graphics processing units, GPUs, following NVIDIA's cloud partner NCP reference architectures and software stack at its data centers in Quebec by summer of 2025, with expansions planned at its facilities in British Columbia. The Sovereign AI Factory will leverage Telus's high-speed, ultra-low latency fiber optic network with sustainable data centers powered by 99% renewable energy sources to deliver AI as a service. And Telus, the world-class data centers, are designed to be 3 times more energy efficient for excess power usage than the industry average, using significantly less power electricity to power AI computing workloads. The facilities also rely on natural cooling and cutting water consumption by more than 75% compared to traditional data centers. With these efficiency measures in place, Telus Sovereign AI Factory will be one of the most sustainable AI-ready data centers in the world. I mean, this is like absolutely incredible. We'll read a little quote here. Canada has made AI a national priority, investing in talent, research, and commercialization. The Telus Sovereign AI Factory now provides the infrastructure for this innovation to scale, empowering Canadian businesses, startups, and researchers with access to cutting. I mean, we know what's going on here, right? So this is one of the most incredible things I think Telus has announced in a little while. And again, this is why Telus, I believe, is on the forefront of things I care about when it comes to telehealth, security. Basically, everything that they're touching, I think, actually have growth vectors behind it. Unlike Bell, unlike Rogers, they're just not my favorites because, again, media infrastructure. I do not like media at all. I just want to avoid media, and I don't like that telecom partnered with media, whereas Telus is partnering in the health sector, in the security sector, in the AI cloud. Like, everything they're doing feels right to me. Now, again, I'm not talking that these are highly explosive, growth-oriented companies. Like, I wouldn't be buying these for growth. My curiosity and my bull thesis on it is purely that you're getting a full rate of return out of the dividend. If they can maintain the dividend, which I'm speculating they can, at a 7 to 8% yield, that is your full rate of return. You should be happy with that, unless you're greedy and you want to go chase nefarious, insane returns. If you want 10 to 12%, get it out of the S&P. I'm not talking about throwing your whole wealth at this. I'm just saying, for me, I figure I can get my full rate of return from the dividend, and I believe it is trading at a relative discount today. Because I think we're going to see a bump in recovery from everything they've been doing over the last year or two, especially with interest rate cuts, finally adjusting the layoffs, all that stuff. So that should start to recover. I'm expecting we see like a good 10 to 25% hike in the stock price. So I'm expecting I can get excelled returns from where the stock sits today, presuming all that cleanly comes into play and the market recognizes that value. So that's kind of my thesis with this. And it's a company that's done an exceptional job at doubling the dividend over a decade, though I'm not sure if that's going to be possible in the decade moving forward. I'm not really sure. It's hard to tell if they're actually going to be able to maintain the dividend growth they have, but time will tell. We shall see, because these companies tend to hold on to these dividends and they know their shareholders are owning it for this reason. It's why we didn't see Bell cut, even though people were saying they had to cut. Why would they issue new shares to pay the dividend to people on a drip system? Just seemed insane. Like, just cut the dividend, keep the shareholder value instead of diluting. But there's a lot of convoluted nature to these. I'm not saying it's all cut and dry and super clean. It just is what it is. And just on an anecdotal note, in tandem with Telus here, I'm really shocked to see the advancements that China's having right now in competition when it comes to these GPUs. The competition with cloud and quantum computing, because a lot of people like to crap on China a lot, and I think it's a lot of propaganda, but China likes to put out their own propaganda. But it seems like China's doing a great job right now at catching up, which is why I think global diversification matters. And I just want to anecdotally finish on this, because China achieved quantum supremacy claim with the new chip, the 1 quadrillion times faster than the most powerful supercomputer that's rivaling Google's new Willow. And they also announced that they are basically working on, a competing lithography machine in competition with ASML. And I'm really intrigued to see how China catches up and what the advancements look like, because I really believe we're in kind of a technology race right now, and people like to shun China and prop up the United States. But this is why I think, China's in a new bull run that is likely to continue, and it's something that I'm glad I can get exposure to through things like XEQT. But I just wanted to add that because, I'm really curious to see where NVIDIA goes from here, where ASML goes over the long term, and because ASML has been undisruptible for a very long time, as they're the primary bread and butter to these chips, right? Like, these are the chip manufacturing machines that NVIDIA is buying, that Taiwan Semiconductor is buying. Like, this is the ground floor to all of the manufacturing of these chips. So it's going to be really neat to see if a competitor can actually rise up, to a company like this, especially if it comes out of China. Will be really interesting. But I will pass the question off to you. What do you guys think about all of this in that comment section below?